Welcome back to the next module in the stock option trading series, and today we're going to talk about relative strength index, or the RSI. So what will we cover in this module? We're going to talk about what the relative strength index is. We will discuss what is the formula to calculate the RSI, how do we analyze the RSI, what are the limitations of the RSI. I'll show you a chart example of the RSI indicator, and we'll discuss how we can use the RSI for stock or options trading. So let's get started. So what is the relative strength index? Well, it was developed by J. Wells Wilder Jr. in his 1970 book, New Concepts in Technical Trading Systems. The relative strength index, or the RSI, indicates momentum and measures the magnitude of recent price changes to determine if a stock is overbought or oversold. The RSI is displayed as a line graph, also called an oscillator, that moves between the 0 and 100 values. So typically a 14-day time frame is used to calculate the RSI for a stock. Values of 30 or below mean that the stock is oversold or undervalued, and values of 70 or above mean the stock is overbought or overvalued. This can help us determine if the stock is primed for a trend reversal. So what is the formula to calculate the RSI? I give you the two formulas here, although this is not important as most, if not all, charting software calculates the RSI for you. But as you can see, the average gain or loss is represented as the average percent gain or loss, and we typically use 14 days worth of data so we can refine the formula. So charting software will do the calculation for you on the fly and will plot the line on the graph, usually below the stock price chart. This RSI value will increase or decrease based on the number and size of the gains or losses. So how do we use the RSI? Well, a bullish divergence occurs when the RSI demonstrates that the stock is oversold, meaning the RSI is 30 or less, followed by a higher low in the stock price. This suggests a bullish momentum. A bearish divergence occurs when the RSI demonstrates that the stock is overbought, meaning the RSI is 70 or above, followed by a lower high in the stock price. This suggests a bearish momentum. So what are the limitations of the RSI indicator? Like all technical indicators, it is not 100% accurate. Since the indicator displays momentum, it can stay overbought or oversold for a long time before the stock reverses direction. Here's an example of the RSI curve shown at the bottom of the screen in purple on the stock graph for AMD. As we can see, our values go from 0 to 100, and the purple shaded area corresponds to the 30 and 70 RSI levels. So we can see the line graph changing day by day as the stock price for AMD changes. So we can see we are currently at the 50 RSI level. This graph makes it easy to determine if the stock is overbought or oversold. If the RSI goes above this dashed line here representing the 70 RSI level, we can clearly see that the stock is overbought. If the line graph drops below this 30 dashed line, then we know that the stock is oversold. So how can we use the RSI when we trade? Well, we can use the indicator to place entry orders, stop loss orders, or set price targets when we're buying or selling stocks. And we can also use it to determine our strike prices for trading stock options. So in summary, the RSI indicator helps determine whether a stock is overbought or oversold based on its momentum. A stock is considered overbought when the RSI is above 70 and oversold when the RSI is below 30. And like with all technical analysis, the RSI should not be relied on exclusively. Happy trading!